Welcome to the Sojourn Wealth Management Podcast. My name is Jeff Bronner, and I'm here with my co-hosts, Corey Akins and Andrew Kraft. Today, we're going to be covering common mistakes made when managing your assets. And some of what we've talked about in previous podcasts, but we're going to pick up the ball and keep running with it and talk about how this touches on other aspects of financial planning. So the first thing we want to dive into is asset allocation. And Andrew, I know that you have a lot to say on this, so why don't you start us off?
Yeah, as you mentioned, we touched on this some both last time in retirement plan mistakes, and then also just the review of, I guess, the first kind of part of the year on an earlier podcast. But basically, it's just making sure that your assets are diversified. And when you are starting out in a retirement plan, you often just kind of choose a few different funds, or maybe you have investments at a bunch of different companies. And so just kind of really knowing what that term diversification means, I think is helpful. And the key with diversification is trying to make sure you have some assets that zig when others zag. And so if you have investments at 3 different companies, and we'll just pick 3, Fidelity, Vanguard, BlackRock, for example, you might think you're diversified, but you might have a lot of the investments as the same. Or you might just have one mutual fund and think you're diversified because you have 500 different holdings inside that mutual fund. And while that's great and it's better than just one stock, for example, it might all be focused in a specific industry, technology like we discussed a few podcasts ago, or just large cap growth, or just the S&P 500. But still, you might want to have some international exposure or bond exposure or small cap. And so just kind of allocating your assets and just thinking that you're diversified when you might not be, I think is one of the common mistakes of managing your assets.
Yeah. And typically like when you're talking about diversification and making sure that you're allocated properly, that's an ongoing thing to do, right? Like an ongoing project, because your assets are allocated and then you're continuing to work, and then that asset allocation should change over time, right? As you get closer to retirement, your asset allocation is going to reflect a probably more conservative. Go ahead, Andrew.
Yeah, I was just say, before you even kind of get to what you're going to talk about, being more conservative, just in your own mix, as you're going through, your working life, if, for example, you have a 70-30 mix and stocks do really well, you want to have that process of reallocating, because stocks go up to, say, 80%. Well, now you can sell those and you kind of automatically are selling high, and you're buying fixed income, for example, or a different part of the market that is automatically low. So, yeah, I think that process you bring up is an important point as you go along before you think about wholesale changes.
And even before we get to what I was going to say, now that you've piqued my interest on this, like that's efficiency, right? So if you have that 70% equity, 30% fixed income mix, a given quarter can really change the way that those percentages look, right? So it may go up to 80% equity, 20% fixed income, and doing that process of rebalancing and reallocating helps it get back to kind of that true risk objective that you have, depending on where you're at career-wise.
Yeah. So the set it and forget it might be a mistake kind of as you're going through.
Mm-hmm. Absolutely. Which, to my next point that I'm thinking about, is like a target date fund that you might have. Like, you just sign up for the 401k, you have the target date fund, and it's based on a time where you're going to retire in 2055. And in 2050, you may be 60, but you may want to work till 70. And so that target date is kind of off by 5 years.
Right.
And then give or take, it could be, what if you decide that you want to retire early? So that kind of same process there, where it's diverse, but it's not necessarily efficient. I think it's a key component as to why we're talking about ongoing monitoring, ongoing check-ins on the account.
Yeah, for sure.
And that gets into, you guys are talking specifically about asset allocation, whether it be making sure that you're diversified across different broad asset classes, specific sectors, Andrew, like you were talking about. But then there's also tax strategies and tax diversification methods and things that can be implemented while you're still working, moving into retirement. Can you guys unpack that for our listeners?
Yeah, that's a great point because while you are still working, you have an eligibility to make contributions to IRAs. And so, one strategy that can really help if you are a high income earner and you're not able to make contributions directly to a Roth and you can't deduct contributions to a traditional, then you can implement a strategy called a backdoor Roth conversion. And so, I won't get into all the mechanics, but it basically allows you to put money into a traditional IRA and then convert it over to a Roth so you can kind of fund future tax-free dollars that you might think you couldn't do because of your income.
Right. And just to follow up on that, so the backdoor strategy, and we're not going to dive way into the weeds on it, but that is where somebody who makes too much money to make Roth contributions would just put non-deductible contributions to their traditional, and then that flows through as a conduit to the Roth IRA, thus getting them
Exactly
the ability to have the tax efficiency on the back end. And that's a little bit different than just kind of a Roth conversion too, right?
Mm-hmm.
So you can have a traditional IRA that is, a normal traditional IRA that has deductible contributions to it, where you're taking a part of that depending on where your tax rate is, and then converting it to that Roth. So both of those aspects are really important too.
Yeah. And I think having that, talking about allocation, Jeff, the taxable and tax-free is another level of allocation.
Right.
So thinking in retirement, it might be good to have some tax-free funds from a Roth component. And so, a lot of times it's great to while you're working to begin filling up that bucket as opposed to thinking, well, my income is higher when I work than when I'm retired. Yes, that's typically so. And so your income tax will probably be higher when you're working. Yeah, probably so. However, when you're retired, it just frees up some, options and some flexibility if you don't have a tax on every single dollar you take out of your retirement account. So.
That's right.
And so part of the mistake in that is not thinking ahead and preparing yourself for that maneuverability with the tax diversification in your specific portfolio. So one of the things, and we're going to talk more about how Roth conversions can move into income sequencing at the tail end of this episode. So we'll dive more into that in a second. But once someone gets to the point of where they're wanting to step away, so we mentioned, the target date funds that you can find in a lot of workplace accounts. Someone retires, for example. What should be something that they're thinking about, or a potential pitfall, common mistake that they could make once they get to that point?
Go ahead, Andrew. Sorry.
Yeah, no, I was just going to say, there's a lot of mistakes. So I think just a few. So the target date fund, we've been kind of hitting on that a little bit, but it's a good fund, but there's some inefficiencies, and it's one of maybe 5 or 7 different target date funds are typically inside a retirement plan, and the total though is more like 15. Maybe 20 if you're in a good plan. So there's not a lot of options in your employer plan. They typically do cover the major asset classes, so it's fine. But when you retire, it's good to think about rolling over those funds into an individual retirement account or retirement arrangement, because you can actually have it invested the way that you want it to be invested, the way that your plan needs to be invested, increase diversification, have a lot of other options that aren't available inside the retirement plan. And I think you mentioned taxes also, that there's a benefit there. I don't know if you want to touch on that some, Corey.
Yeah, well, the 401k or the workplace plan is going to have a 20% mandatory withholding. So if you take money out, you're going to have to withhold that 20% even in retirement. So if it creates that implication as well, but typically, it's also just a little bit more cumbersome to get money out of a retirement plan than it is to roll it into an IRA and then just hit a button and it is in the bank account. And that can even be extrapolated out when you have maybe an older plan that may still have annuities in it. So that just can kind of compound that.
I think you think of something else also. When you retire and leave, if you leave your money in a plan and now you're 10 years away from your retirement, like you said, it may be an older plan that could have been inherited or moved. And so the employer has changed who's managing that. And so now it's even more cumbersome to get money out.
I have encountered that exact situation numerous times, where you leave a place, they change the management of it, and you have a deadline. Well, typically people don't open mail that doesn't look familiar. And then all of a sudden they have this account that is no longer there, and it went to an IRA company or just another company that they've transferred it to, and you don't know where or how to get to it. That can be a problem, right? Not knowing where your money is a problem.
You never want to have to chase down your money.
Yeah, exactly right. Another example too that I think of, especially with like the target date allocation. So most people don't just have one 401k, or that is not their only asset over the career. So that if you leave it there, it might not be working in conjunction with your other retirement assets too. So if it's just in a target date fund and it never gets looked at or rebalanced or reallocated, then it may be way too conservative for that portion of your money. So just something to keep in mind, I think, as you're thinking about these things.
Yeah.
So from overall, just again, asset diversification opportunities from moving into an IRA, some of the tax efficiencies that come with moving into an IRA, things to evaluate, as well as just holistic financial planning. One more thing on those points, because we've talked about folks who have like company stocks and a workplace account, and there's some tax stuff there. Corey, do you mind unpacking some of that for us?
Yeah, that's good.
Yeah. So if you're working for a company and they allow you to purchase stock within a 401k, so we'll just use that as our qualified retirement example. There is a great solution called net unrealized appreciation that when you leave that employer, you can actually be more tax efficient, because the net unrealized appreciation, or NUA, is going to be the difference between the cost basis or the original purchase price of the employer's stock in the plan and then its current market value when it's distributed. For easy example, say you started at a company, you bought employer stock, you paid $25,000 for it, and that was 10 years ago, and now you've left the company and that stock is worth $100,000. If you take that money out as is, whether it's a 401k or an IRA, you're going to pay your income tax rate on it. But there's a way that you can actually pay capital gains tax on the majority of it. If you take the stock and move it out into a brokerage account and pay the $25,000 that I talked about with the cost basis as your income tax, the $100,000 that you moved out, you can now take out at capital gains rates, which are always going to typically be lower than your income tax rate. And so that's just another way of, if you have stock in the plan, don't make the mistake of moving it to an IRA and then distributing it from there, because there's probably a more tax efficient way to do it over the long haul.
Yeah, because they'll sell the stock inside the 401k before they send the money to the IRA.
That's exactly right.
Yeah.
But if you move it out of the 401k, it just goes to the brokerage account in kind, and then you still own the stock. You can do whatever you want to with it at that point, but you're going to be way more favorably treated from a tax perspective. Like you could even, if you do it right, you could even pay 0% tax on some of that money. And then long term, I know I'm getting a little long-winded, but just long term, that has a step up in cost basis for your heirs as well. So like if you don't need the stock, you pass away, it goes to
That's a great point.
your beneficiaries. And now you've got this stock that's now worth $100,000. Whoever inherits that is going to get it at the market value as their new basis.
And how much does Uncle Sam get in that situation?
0.
That's a good thing.
And so long-term planning, I think, lends itself to strategies like that.
And that gets back to your earlier point about holistic financial planning. What are the actual goals that we have overall? And how do each of these different assets, whether it be the 401k, a brokerage account, an IRA, what have you, how do they all plug in to our ultimate goal?
Yeah. And then how do you sequence that out, right?
Yes.
So like how do you do all that we just said, but then how do you take it, right?
Work together.
Yeah. How does it work together? And then, we'll talk about income sequencing here, but that's the question, right?
Absolutely. How this all works together into an overall plan when you're thinking about drawing out and distributing your assets, you need to have an income sequencing plan. And one of the common mistakes we see is people don't have that. And there are a couple of things that will sneak up on them or strategies that they will miss out on. So one of the big things is that people don't think about or don't know about required minimum distributions. And required minimum distributions are essentially when the government requires you to distribute assets from your qualified retirement accounts, qualified retirement plans, like your individual retirement accounts we've been talking about, 401ks, so on and so forth. And so one of the things you can do in leading up to that, once you retire, you're in a lower income tax bracket because you're not working anymore. You have all of these assets in these qualified accounts. You can do what's called a Roth conversion, where you start converting those assets from those qualified accounts into Roth accounts. You pay the taxes in that year. And then over time, you do that year over year leading up to required minimum distribution age. And then that allows you to lower that amount that the government is requiring you later on to create a more tax efficient income distribution plan in retirement. And this is something that, a lot of folks aren't aware of. They didn't know. I was telling a client about the other day and he responded to me with, "Wow, that's the cat's meow." Which I said, yes, that's a great way to describe it. Because again, a lot of people don't know about it. A lot of people aren't thinking about it. That's a common mistake people can make, is missing out on that strategy to avoid that higher tax burden later on when the assets continue growing and then you get to that older age and you have all those qualified assets sitting there.
Yeah. And speaking of trying to mitigate those RMDs, one strategy is throw another acronym out, QCDs, Qualified Charitable Distributions. And it used to be linked to the RMD age of 70 and a half. But as that's been pushed out, the ability to do QCDs is still at that younger age. And so what that basically means is you direct funds from your IRA directly to a church or charity, a 501c3 organization, and it's not counted towards income. And so it can lower your account that ultimately you'll have to take RMDs on. And then later on, when you are required, it counts against those. And, one other strategy I'll mention about lowering RMDs is it doesn't happen as much anymore because they've been pushing the age out. But if someone's 71 or 72, in the past, we'd run across this frequently and they were working still, they could roll the IRAs back into their employer plan, because if you're working, you don't have to have RMDs from your employer plan. But then when you retire, you do, which is another mistake. People don't take advantage of that benefit, or they forget that it's required from their employer plan as well.
Yeah. In that same vein, too, taking Social Security early, right? So hitting 62 is a common mistake because, and it feathers in, I think, to what Jeff is saying, is that if you get to retirement and say you're in your early 60s and you're in a lower tax bracket, the longer you delay Social Security, the better it's going to be on the back end. Mm-hmm. And so it gives you an opportunity then to take money out of assets, and you're going to pay lower taxes now. And then implementing that conversion strategy, you can convert more. And then you've got a pretty good time period to convert and then move those assets into a strategy that's going to be very tax efficient on the back end. And then, that gap from 62 to 70 where you were taking assets, you're just letting Social Security kind of accumulate. Mm-hmm. Well, then boom, okay, now at 70, you start taking it, or full retirement age, you start taking it and the benefit's better. And you've, in a tax efficient way, you've kind of stretched those assets and can now even start utilizing some, Roth from the conversion. So,
yeah. And I think it's important to note that when you say the Social Security accumulates, that delayed income credit that Social Security gives to the income is roughly 8%.
Yeah,
and that is a percentage that is hard for someone to guarantee. And so if you're potentially being told, "Hey, start Social Security early and leave your assets over here to grow," there may be a little bit of conflict of interest there. Just kind of encourage folks to weigh the benefit of taking money out of their invested accounts and letting that Social Security delay and benefit from that 8% roughly, a year income increase.
Yeah.
So you get the benefit of the higher Social Security payout while utilizing that lower tax bracket when your taxes are lower because you've retired. That one way that's referred to is called the retirement landing strip. You retire, and then before you start taking Social Security and before RMDs, you take advantage of those income years to pay the least amount of taxes that we possibly can.
Yeah.
That's a tax strategy and a tax planning tool that we oftentimes talk folks through and have them consider when they're approaching that age.
For sure. Yeah.
Well, I really appreciate your guys' time and attention to these things. It's been a pleasure reviewing this with y'all. I hope that the listeners have enjoyed it, and I hope to see you guys next time on the next episode.
Good to be here, Jeff. Thanks.
Thank you, Jeff.
Thank you for listening to this episode of the Sovereign Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth